Hello, Finamisers. Welcome to another Finamise Live. I'm Russell, an analyst here at Finamise. I'm happy to host today's event on secret strategies of a long-term investor with our partner, Belong. First, we've got some housekeeping we have to run through. If you're coming in, please fill out the poll. Feel free to introduce yourself in the chat. Tell us where you're tuning in from. Remember to switch to all attendees so everyone can see your messages. This is going to be a 15-minute discussion followed by a 15-minute audience Q&A. Please use the Q&A box to ask a question, and if you see a question you like, upvote it so it moves to the top. That way we can get through the most upvoted questions first. Okay, so let's kick this off. Our event partner today is Belong. It's a wealth building platform on a mission to embolden a new generation of long-term investors. Belong's encouraging young people to get started earlier and tackling the blockers that stop us from taking a long-term perspective on investing. Belong is the first wealth building platform to offer customers an optional low interest boost loan, which enables more money to be invested up front, enhancing investment returns over time. Customers then repay the boost loan separately in small monthly installments, allowing their investment to continue to grow. So today we're excited to welcome Sam Rosenberg, co-founder and COO at Belong. She's a behavioural economist with deep expertise in long-term financial decision-making. Sam is not a financial advisor, and everything she will share today is based on her own experience and expertise as a behavioural scientist. Sam, it's great to have you here today. How are you doing?
I'm very good. Thanks for having me, Russell.
It's a pleasure. Okay, so let's sort of dive in. You've spoken before about the three basic principles of long-term investing. What are these?
Yes. So I speak about these a lot, and as a business, we speak about them too. And that's really the first one is buy and hold. So the stock market goes up and down every day, but 100 years of history has shown us that it tends to go up over the long term. Of course, historical performance is no guarantee of future performance, but it's a pretty good indicator. So buy and hold, taking a long-term perspective. It's in our name, be long. Secondly is around diversification. Buy the market. You don't have to pick stocks. You can invest in these beautiful things called index tracking funds, which essentially track the broader market. It's an easy and straightforward way to diversify your investment without, as I say, having to pick stocks. And then thirdly, really taking advantage of the power of compounding. It's a simple fact that the more you invest and the longer you leave it, the faster it grows. And in order to build wealth, you need two things. You need time and you need money, because you need your money to compound over time. And we will never have more time ahead of us than we do right now today. So what we should be doing is leveraging that advantage of time that we have.
I want to touch a bit more on compounding because it is such an interesting sort of part about investing. So do you want to sort of spell it out a little bit more detail?
Yes, of course. So as I said, the more you invest and the longer you leave it, the faster it grows. And really what it comes down to is investing more earlier so that, because how it works is when we're younger, we have all this time ahead of us, but we feel like we have less money to invest. And when we're older, we typically have more money that we've accumulated, but not as much time for it to compound. So we're almost stuck in this paradox. And if we can find ways of investing more when we're younger, when we have that time ahead of us, whether that's all at once, whether it is pound cost averaging over time, that consistency of having more in the market, because it literally grows faster as you leave it there.
Great. And then, the behavioural scientist side. So what do you think are the most effective behaviours and traits for building long-term wealth?
I'm going to answer this question in a slightly different way. There are these biases that exist. As humans, traditional economics will say that we're perfectly rational. Behavioral economics says that, in fact, we're perfectly irrational, in that we're irrational in these predictable ways. And the most effective long-term investors are those who can neutralize and hack the biases that prevent them from these predictable biases that prevent them from making sound long-term investments. So and this is all based on behavioral science, but also research that we've conducted as a business over the past 3 years. So one that we see coming out a lot is this this feeling of wanting to hold on to more liquidity than we need. You should have an emergency fund. The traditional wisdom is that that's 3 months of your non-discretionary expenses. You should have cash that you need to live, but anything above that can be invested. But we feel like we want to hold on to it. We tend to hold on to more than we need, and it's because seeing that money sitting in a bank account feels safe. Feels like a little safety blanket. It feels like we have control over it, and investing it feels like giving up control. And so that's one of the things. It's one of our biases is investing equals giving up control. Another one is what we call the sunk gain fallacy. So I'm sure we all know the sunk cost fallacy, where you continue doing something because you've already sunk the cost. The sunk gain fallacy is where you continue to not do something because you feel like you've already sunk the gain. And how this manifests is people saying, oh, it's too late. I should have started 5-10 years ago. And now I'm 35. There's no point in even starting. I've really sunk the gain. A third one is around discipline. So a lot of, young people looking to invest, they are smart enough to know that if they start, in order to make it meaningful, they need to continue and create a habit around it. And we think, I'm not the kind of person that has that sort of discipline. So I'm not going to even start in the first place. There's no point in starting because I know that I won't have any follow through. And then the fourth one, and I would say that this is the biggest one, it's present bias. As humans, we are inherently present biased. We favor the current self over the future self. And in fact, science shows that when we think about the future self, it is the same neurons are firing in our brain as when we think about a total stranger in the future. So the future self is essentially a stranger to us. And the present bias exists for a reason if you think about just basic self-preservation, but the way it manifests in our financial decision-making can be dangerous. Because, if I link back to the poll that we asked at the beginning, typically and I see from the responses that we actually have some very good long-term thinkers in the audience, but typically when you ask someone, would you rather have £100 today or £1,000 tomorrow? Most people will say £1,000 tomorrow. If I say you can have £100 today or £1,000 in a year's time, most people take £100 today. And it's that instant gratification. And long-term investing is inherently delayed gratification. And that takes a lot of, as I say, hacking the bias to overcome that.
So I think that's lots of great information there. So this hacking the bias and trying to change what maybe we're inherently designed to do by behavior. Are there daily or weekly habits or something you can try to do to teach yourself to try to stay disciplined or try to kind of think like that or act like that?
Yeah, there absolutely are. I think one of the things about behavioral science is just being aware of it doesn't make it go away. I'm a behavioral scientist. I've been studying it for over 10 years. I'm still a very irrational human. A lot of our decisions happen in system 1, which is our fast thinking, and the power is in moving these sorts of decisions into your system 2, which is the slow, deliberate thinking. That's one thing. Another thing is practicing delayed gratification, which I'm going to double tap on in a moment when we speak more about patience. I think there's a discussion about patience that we'll have. An important one, thirdly, is controlling our loss aversion. So loss aversion says that we feel a loss, the pain of a loss, twice as much as the pleasure or the gratification of an equal gain. Which means that if losing £100 in the market is equivalent to gaining £200 in the market. And that's why when we see that little number go down in our app or wherever we're tracking our investment, we panic because we feel that loss so powerfully. And I think just controlling that loss aversion is a big one. Not being too obsessed with checking your investment all the time if you know that you are someone that's susceptible to system 1 decision making. And then also, I believe strongly in integrating micro commitment devices into the way that you think about your investments. So one of my favorites is setting up a direct debit or a standing order that goes out of your account every month on the day, this is important, on the day that your salary comes in, to reduce that pain of paying. So before you even feel the pleasure of the salary, send that £100 or however much it is that you'd like to invest each month, and it becomes automatic. Another micro commitment device might be speaking to your partner about it and holding each other accountable, setting up a WhatsApp group with a group of friends, holding each other accountable, any ways that you can tie yourself into that discipline.
So yeah, I suppose, yeah, it's discipline seems to be one of the, almost a set of rules that you need to kind of try and teach yourself to do to kind of stay disciplined. And then I suppose if you're disciplined and you're not, I mean, I 100% agree. Whenever you look at a loss, I go, oh no, and it's like you start to think, oh, should I sell it because it's gone down? I mean, it's like whether it's trading or investing, it's like that nightmare scenario. So yeah, interesting. So I suppose then let's move on to the one that you said, double tap, patience. So I haven't heard the double tap expression before, but let's kind of go patience and just explain what that's about in the world of investing.
Yeah, patience. Patience is a big one. I feel like patience is a very broad word for lack of delayed gratification. So I guess patience equals delayed gratification. If we think about the marshmallow experiment, the famous marshmallow experiment, where a child was put into a room and given a marshmallow and said, if you don't eat this marshmallow for the next 15 minutes, just stare at it, you'll get another marshmallow. And that's how investing works. The kids that don't eat the marshmallow and they just leave it there, they get a larger reward. That's often how investing works, at least if it's diversified and over the long term. And so how that looks when it comes to investing is how do you get the two marshmallows? And a lot of it comes down to, so I've already made the point that the future self feels like a stranger. It's how do you personify that future self? Make that person feel less like a stranger. Because we spoke about the set of rules and all of that, but our brains are our brains, and we are driven by instant gratification, and it's all about how you can make gratifying the current self and gratifying the future self feel as similar as possible. So feel the pleasure of those two things as similar as possible. And there's this great experiment that was done where they showed a group of people an AI-generated image of an older version of themselves, and it showed that they contributed 30% more of their income to their retirement after seeing an older version of themselves. And this comes down to that connecting to the future self, making them feel less like a stranger, as I say. And there are different ways of doing this. I've got my own story I tell myself in my head to hack my bias. But that's, I think, really what it comes down to.
It's really interesting. I hadn't heard the marshmallow story, to be honest with you. So that's a good one, yeah. And the AI one, well, obviously that's quite a new study, I guess, yeah.
Yeah.
Okay, so we're almost at the time to open up to some of the Q&A. So please feel free to sort of put your questions in the chat, and sort of we'll try and work through them. So question one that's sort of sitting up there are like the two main traps you see retail customers falling into. So what are the mistakes that everybody makes basically just when they start off their investing journey?
I think one is, and this is, I'll answer this based on the research that we've done. One is, and as a behavioral scientist, I'm going to stay true to my behavioral scientist background and speak about the behavioral traps that we fall into. One of them is feeling like we don't have the expertise to invest, that you have to be an expert investor to start investing. And that creates a whole lot of confidence issues. You don't have to be an expert investor to buy an index tracking fund. As long as you're getting the advice that you feel that you need, and you're making an informed decision and you understand the decision that you're making, you don't have to be an investor. We often hear that I'm not an investor, so I can't invest. I think another one is thinking that you have to pick stocks in order to invest. We conflate picking stocks and investing. You don't have to pick stocks. You can, as I say, invest in index tracking funds. And yeah, and then I have to just mention just the panic selling when the market goes down. What I found really, really helpful for myself is just looking at a historical graph of the stock market and seeing what it does. And, if you had invested in the S&P, for example, at the very top of February 2020 or the very bottom of March 2020, a month later, you'd still be up today. And yeah, so just seeing how the market has performed before when it drops usually helps.
Yeah, I think that one about the index and that diversification is kind of key, because as soon as you go down the single stock route, the volatility picks up, the prices jump up and down much more, and it can create a little bit more emotional stress.
Yeah.
And I think the question here is, what are your thoughts on borrowing to invest? Is that sort of something that we want to touch on today?
Was that really a question? I love that was a question. My thoughts on borrowing to invest are, if the person who asked that question is familiar with the belong proposition, that is one of our features, as long as it is done in a responsible way. You are investing only what you can afford to lose. You are borrowing only what you can afford to repay each month. It, of course, depends on the structure of the product and how it's structured. But as long as those two things, it's done in a responsible way, it's money that you can afford. You're investing money you can afford to lose. You are borrowing money you can afford to pay back. And in my personal opinion, it's over the long term. I think that it's a really, really clever way to build long-term wealth. We can borrow money to invest in a single idiosyncratic home. We should be able to borrow money to invest in an index tracking fund.
Perfect. So the next question is a bit of a long one, so bear with me as I go through it. It says, what are some of the ways of making the future self and goals tangible? And beyond the AI image, is it good to set specific spending goals for the future to make it feel more real while you're investing?
Yeah, I love that. I mentioned earlier around my own personal, I'll start first on the future self, because I think those are there's two questions in there. So on the future self, I don't think I've actually ever told anyone this before, but the way that I connect to my future self is, I actually can't believe I'm saying this to 123 people, but I had a very close relationship with my grandmother, and I've always figured that one day I'm going to be someone's grandmother, and the thought of that person struggling through retirement or not having financial security or financial independence, it breaks my heart, and that's the thing that drives me. So I actually don't connect to, I connect to my future self through my grandmother, and you could do that through your parents. But that's personally how I do it. When we think about goals, I often get asked a question on how do you set goals? What's a good way to set goals? And it's exactly what is said in that question. It's making them really tangible, like weirdly specific. I want to buy a house on this street. I want to save up for a down payment on a house on the street, a 4-bedroom house on the street. And that can change over time. You can change your mind. But as long as your goal is always very specific, it makes our brains love stories, and they love visualizing things. And the more real it feels, the more likely we are to commit to it. And the more likely we are to feel the pain of an opportunity cost when we feel ourselves diverging away from the plan. Because I've now got my heart set on this down payment for a house, and it could be a car, it could be sending my kids to school, it could be a trip that I've always dreamed of taking with my siblings. But as long as it's very, very clear, it feels real, not contributing to that plan is going to be painful.
So it's quite I think the point is it's got to be something personal that you can really feel. It's not something generic. We try to take it from a personal experience to try to keep it, to make it tangible.
Yeah. And the important thing is that it can change over time. So people typically tend to think long term is 5 to 10 years. When we say what is long term is 5 to 10 years. So just always thinking 5 to 10 years out, and your goals will change and you'll achieve them and you'll have new ones, but keeping them specific.
Excellent. So next one going on, what are the main signs to suggest you set out with your investment? e.g. the best time to sell a stock? Well, anyway, I'll let you answer it because
I'll rather, I have a stronger opinion on the best time to buy, which is when the market's down.
okay, there we go. That answers that. It's like, in my opinion, best time to buy when things have fallen.
The best time to, the best time to buy is when the market's down.
Here's another one. What's the best way that I can convince my brother to start investing? I'm not sure what that relationship is between the two of them, but the question is, what's the best way to convince, if you could have a chat with someone and say, hey, look, you should start investing because.
So I think showing them. So if you invest yourself, showing them how much you started and how much you now have, visualizing it on a graph, showing them how the stock market has performed over the long term, building a mini model for them. In the Belong app, we have a simulator for this, but you can build it in Excel, where you just put in a number that you put in today and an assumed growth rate on the market and how many years that goes for. Really making it real. And that's actually how we tested our proposition in the beginning, was with an Excel model, and we showed customers what they would get if they invested X amount over 30 years. And that was how we proved out our MVP for the proposition, was with that.
Interesting. Okay, there we go. That's a great answer. Next one. Alongside long-term investing, do you agree with the core satellite approach too? So allowing a small percentage to go towards potentially more tactical opportunities, while having the majority invested maybe in longer term index or broad index.
Yeah, personally, I believe in having that corner. This assumes you've got your emergency funds and money you need to live. Above that, I believe in having a cornerstone long-term investment that's your responsible money. And then if you're up to it, and if you will certainly do things in parallel. But I think the danger comes in when you're only doing the speculative things without the cornerstone investment.
Makes sense. Yeah, only invest what you can afford to lose at any time there, and that's a part of the same journey.
Yeah.
Next question. What are some good credible sources to learn and to get your investment game started? This can even be influential people that you believe produce good content, or maybe investors that you sort of like maybe agree with, or you've studied that you sort of think, oh God, that's a great approach. I really believe in that one.
Finimize.
That's a great answer.
This is probably a painfully boring answer, but it's true. Warren Buffett. The Warren Buffett approach. If you've got anything less than £100,000 that you're looking to invest, buy the market, buy an index tracking fund, leave it there, and let it compound over time.
Perfect. Yeah, makes sense. What are your thoughts on alternative assets? I'm assuming, well, anyway, I'm not going to assume anything. Yeah, I'm going to say, what are your thoughts on alternative assets?
It's the same as my thoughts on the satellite approach. As your cornerstone investment, do what you can afford.
Right.
And make sure you're taking financial advice along the way.
So next question, what's the benefit of borrowing money to invest against using leverage or options, which effectively is also borrowing money in the sense that you buy or sell into a position that's larger than your initial capital or equity is? So borrowing money to invest against leverage or options is the question.
Yeah, I think it comes down to your risk appetite, your sophistication as an investor, and whether or not it's a short-term punt, if you will, on the market, or a long-term investment. Those are the key differences. So the way that our product is structured is that there's no mark-to-market. There's no forced selling. You'd never be asked to bring more money to the platform as long as you keep making your repayments. It's structured very much similarly to how a mortgage is structured, rather than how other sorts of leveraged investing products are structured. So it's different.
Yeah, agreed. Yeah. And then nice question to start you, well, how much do I need to start investing? I know we've covered it already, but just to know, it's part of it's a question and it's a good one. So, if you're just beginning on your journey, how much do you need to start?
That's different for everyone. I'm going to sound like a broken record, but I'll say it again. As long as you have your emergency funds, 3 months of non-discretionary expenses, and as long as you have money you need to live, it's whatever you feel comfortable with, whatever you can afford to put away for the long term, and not be absolutely down and out if you were to lose it, which is always a risk with investing. From a behavioral perspective, what is and that could be £10, it can be £100, it can be £10,000. From a behavioral perspective, it should feel meaningful, because you want to coax your brain into feeling a sense of momentum, like you've taken that first step, because the first step is always the hardest one to take. And once you've taken the first step, you'll be more compelled to continue. So if it just feels like just testing and just trying it out, you're never going to feel that sense of momentum. So try as much as you can to make it feel meaningful, and like it's a start of your journey.
And then it's one, because I don't know the answer that are stakes in multiple similar market indices unnecessary? So I suppose the other way is, back to diversification. Is it not? It's like, how many different indexes is sort of like diversification? Is it just the S&P 500, or does it make sense to go elsewhere?
I think as a starting point, anything that's broadly diversified across a market, so the S&P 500, MSCI World, the FTSE, that's a really good place to start. One thing to be aware of with some of those those kind of primary trackers, primary index funds, is that they tend to have similar holdings. So if you do truly want to identify, you should be looking at the underlying assets held by the fund. But I think that it can go much further than that. There is a geographical diversification, so investing in developing economies. There's ESG. There's quite a lot of diversification that you can get in with index tracking funds.
Good, yeah, agreed, yeah. Question here: how do you keep people engaged over the long term, as buy and hold feels like it rewards people to almost forget about their investments? I mean, forget about maybe a bit too strong, but to sort of like let them be.
Yeah, no, it's true. There, of course, has to be some sort of behavior around continuously contributing, and feeling a sense of ownership over building it. So we believe strongly in pound cost averaging over time. But it's something that we speak about as internally all the time, is how engaged do we actually need our customers to be once they've made their investment and set up their index, their recurring contributions into that index fund. There is value in it from a literacy and education and engagement perspective, and we're still testing and iterating different ways of engaging our customers and keeping them engaged over the long term. I think a lot of it comes down to going on the life journey with them. If we capture them in their 20s and their 30s, a lot happens over the next 30 years. And it's how we can build and ship products that continue to serve them.
Is great. Sam, thank you very much for joining us today. Unfortunately, we're sort of just about run out of time now. So I hope it's been as enlightening for everybody listening, and sort of it's been really good to me. I love the marshmallow story anyway. I'm going to remember that one. Yeah, I'm not sure whether I'll be able to hold back. The temptation may be too good. Anyway, but please join us for the Modern Investor Summit on the December the 3rd and 4th. It's a 2-day event packed with back-to-back sessions and workshops led by the biggest names in finance. And you can network with your fellow retail investors, and some of the questions that we didn't get answered today, I'm sure there'll be more time to answer some of those as well. Yeah. So you can pre-register for your ticket using the link shared in the chat that we're going through. And if before you log off, you can sort of fill in the pop-up survey that appears on your screen. Please take a few minutes to do that and sort of let us know which topics you're most interested in hearing about at future events. Thanks very much. Thank you.
Thank you.